The power of compounding cannot be denied. This simple phrase is one of the reasons I chose to invest in dividend growth stocks. As we have discussed in previous videos, there are many different types of dividend paying stocks. There's your moderate dividend growers who are just increasing the dividend, or maybe it's just staying flat. There's your high yield dividend stocks, which you're going to get a 5% plus yield. Those are usually going to be slower growing dividend stocks if they're growing at all. And then you have something like REITs, which can be all over the map, but it's just a different type of dividend stock related to real estate. And then there is dividend growth stock, which is by far my favorite type of dividend stock to invest in. And speaking of dividend growth stocks, in today's video, we will look at 5 of the top dividend growth stocks to buy now. Let's go. Hey everyone, Mark here, back for another video. If you are looking for even more dividend content, then definitely check out my newsletter, The Dividend Investor's Edge, where we take a look at and recap the prior week and what happened in the market. We'll take a look at the week ahead or the weeks ahead, which is our on horizon segment, and then do a 3 quick pick segment on 3 dividend stocks that are high on my watch list right now. Also, a new thing that we're adding for newsletter subscribers. You will expect to receive 2 to 3 individual stock analysis. These are deep dives on individual dividend paying stocks, and you will expect to receive 2 to 3 of those each and every month. Check out the link down in the description below to sign up today. For me, I like dividends for the idea of passive income, earning money while I sleep. But to take things even further, if you're going to tell me a dividend stock that is growing its dividend each and every year at a rate of 10% or more on an annual basis, that takes things to a totally different level. Of course, dividend growth is just one of the things that I look at. Of course, fundamentals play a huge part, so it is very important that you do your due diligence before investing in any stock. Again, I am not a financial advisor, so please do not take any of this as financial advice. But in today's video, we are going to look at 5 high-quality dividend growth stocks, and they share a few things in common. All of these companies are high quality. They have strong management teams, a strong business model, and all of them, every single one of them that we will look at today, are growing their dividend at an average annual rate of 10% or more over the past 5 years. In addition, these dividends are not only safe, but supported by a fortress balance sheet. And the best part of all, they all appear to be trading at great valuations. Before we jump into the video, I want to mention an awesome promotion that's going on right now with Webull. Down in the description below, I will put a link to this special promotion to where if you sign up and deposit any amount of money, so you open up a new account, deposit any amount of money, and they will give you up to 12 free stocks valued up to over $30,000. Definitely take advantage of that awesome promotion. It is only short term right now through the rest of the month. Check the link down in the description below. With that being said, let's jump into the video. The first dividend growth stock that we're going to look at today is Starbucks Corporation, stock ticker SBUX. Starbucks is a global specialty coffee retailer. Its 2 major regions are here in the United States as well as China. The company has a current market cap of $99.7 billion. The company was severely impacted by the recent pandemic. In fact, over in China, the country is just now easing some of those pandemic restrictions that they had. So Starbucks has really seen sales hit over in China in particular. Over here in the US, we've seen price increases. They've had some supply chain issues, but overall, we just saw strong same-store sales here in the United States. Add on to all of that, and the recent CEO, Kevin Johnson, retired this year, which brought back Howard Schultz for his 3rd stint as CEO of the company right now on an interim basis currently. Starbucks certainly has its work cut out for it. With supply chain issues, a possible slowing economy here in the US, they've been dealing with the China issues as well as dealing with their own labor force. But if there's anyone that could do it right now, it is Howard Schultz. He has been able to be a visionary for the company for decades. Looking here, you can see that the only thing that derailed the Starbucks growth train over the past decade has been a global pandemic. This speaks to the company's global brand recognition. Starbucks has a very loyal following, and the people do not mind spending $5 on a cup of coffee. As revenues have climbed, so have cash flows and net income, which has fueled the company's growing dividend. Currently, shares of Starbucks pay an annual dividend of $1.96, which equates to a dividend yield of 2.2%. The company has a 5-year dividend growth rate of 14.4%. In terms of dividend safety, the company has a dividend payout ratio below 60%, suggesting that not only is the dividend plenty safe, but there is still plenty of room for continued growth moving forward. Starbucks has built a strong track record as a known dividend growth stock, having now increased their dividend for 11 consecutive years. We expect that to be 12 here in the coming month. Analysts are expecting big things from Starbucks in the coming years. Looking at the fast graphs chart, you can see that they expect the 2023 earnings per share to come in at $3.41, which equates to about an 18% increase from the fiscal 22 numbers. Using those estimates, Starbucks shares currently trade at a forward price-to-earnings multiple of 25 times, and over the past 5 years, shares have traded at an average multiple of 30 times. Analysts currently rate shares of Starbucks a moderate buy with an average 12-month price target of $93, implying roughly 10% growth from current levels. Overall, the business model is very strong. Howard Schultz is at the helm. We may be getting an announcement on a new CEO. Strong cash flows continue to come in, regardless of whether the economy has slowed or not. People still continue, even at the increased prices. We saw 9% same-store growth here in the US in particular over the past quarter, so definitely take a closer look at Starbucks. The second dividend growth stock that we're going to look at today is one of my favorites, and that is AbbVie, stock ticker ABBV. AbbVie is a global pharmaceutical company with a current market cap of $250.8 billion. I like to refer to AbbVie as the investor's trifecta. They offer growth potential, they offer a high yield dividend, one we have seen much higher in recent years, and they also offer dividend growth. AbbVie has been around since 2014, and it was a spin-off from Abbott Labs. One of the great things about AbbVie is they had the best-selling drug, continue to have the best-selling drug in the world in Humira. Humira for many years has led AbbVie and has accounted for over 70% of their revenue dating back a few years. But fast forward to today, and Humira now only accounts for less than 40% of total company revenues. Now this is due to a couple of things. One, Humira lost patent protection internationally, and it loses patent protection here in 2023 in the US. Also, the company has broadened its portfolio base. There are new drugs that are coming online. They have a very strong pipeline. They also acquired Allergan a few years back, I should say, which has also brought on great new products to diversify the AbbVie portfolio. So instead of it being a one-trick pony now, the company is much more diversified and stronger moving forward. Looking at this chart, you can see how the dividend yield has been above 6% during some time, but has been averaging closer to 4% over the years. Currently, AbbVie shares pay an annual dividend of $5.64, which equates to a dividend yield of 3.98, very close to that 4% average. The dividend is covered by a very low payout ratio of only 42%, again suggesting plenty of room for growth moving forward. So you've seen the share price appreciation. You have seen where the yield has been. 4% is a very high quality yield. Now let's take a look at dividend growth, the third part of that investor trifecta. Over the past 5 years, you can see that AbbVie has increased its dividend at an annual rate of 17.5%. It has also increased the dividend every year since becoming its own company 8 years ago. In terms of valuation, shares of AbbVie currently trade at a price-to-earnings multiple of roughly 10 times, and over the past 5 years, it has traded closer to an average PE of 12 times. Looking at analyst price targets, they rate the stock a moderate buy with a price target of $161, suggesting 15% upside from current levels. The third dividend growth stock that we're going to look at today is Visa, stock ticker V. Visa operates as a credit card services company, a global credit card services company, and has a current market cap of $440.3 billion. Many of you are very familiar with Visa credit cards. No reason to really explain what those are, but there are a few tailwinds that I want to discuss on why I'm high on shares of Visa. Many of you have seen over the past few months that consumers all around the world have a pent-up demand to get out of the house, to go travel. We are trading in a lot of the services. Look at streaming, a lot of those numbers, Netflix, we're down. Streaming numbers are down right now as many consumers are looking to trade those in for things like leisure and travel. You're seeing hotels, air travel up. The number of people going through the TSA turnstiles and pre-check, all of that stuff, those numbers are up as the consumer has a huge pent-up demand to get out of the house. All of these things greatly benefit a company like Visa. Another tailwind for the company is the number of consumers that are taking out more credit. The economy is slowing, and that's usually when we see consumers reach for that credit card a little bit more. It's a good rule of thumb as a finance person is if you have to put it on your credit card and you can't pay it at the end of the month, it's probably not a good idea because you're going to be paying 20% plus in interest fees to these credit card companies. But this can also be a negative for the company because as more consumers have to put and use their credit cards, that also raises the risk that they won't be able to pay off their credit cards. If they pay it slowly, that's actually a benefit because Visa is going to be earning interest income, but if they can't pay it, that's going to be an issue. Looking at the dividend, Visa is not really known for having much of a dividend yield, but part of that is due to the strong price appreciation in the stock. Remember, if a stock price goes up, yield goes down. The company can raise the dividend, but if the stock price is outpacing that growth, then the yield gets left behind. Currently, shares of Visa yield a dividend of 0.7%. Again, nothing to write home about. However, they do offer a near 18% 5-year dividend growth rate and a low 20% payout, suggesting plenty of room for further growth moving forward and a very safe dividend at that. Analysts are projecting earnings per share of $8.40 in 2023, which equates to a forward PE of 25 times. The average 5-year price to earnings multiple is 32 times. Analysts currently rate the stock a strong buy with an average 12-month price target of $255, implying 22% upside from current levels. The fourth dividend growth stock that we're going to look at today is L3Harris Technologies, stock ticker LHX. L3Harris hails from the defense sector. They are a defense contractor. The company currently has a market cap of $45.6 billion. Defense spending has always been a high priority here in the US. It may be slower under certain administrations and faster growing under other administrations, but nonetheless, defense spending is always a high priority and a high budget item. But since the invasion over in Ukraine, we have seen those budget and those priority levels increase even higher, and not only here in the US, but across our allies as well. And what this does is creates a long runway of growth for these defense contractors. Defense spending is not something that you can ramp up overnight. A lot of this takes years to really come to fruition. So what this does is as these budgets go up, it's going to just create a longer runway of growth for these defense contractors, including L3Harris. L3Harris is unique and has differentiated itself in many ways from the other defense contractors like Lockheed, who simply relies heavily on its fighter jet program. L3 is more technology-based, as you could guess based on their 3 operating segments: integrated mission systems, space and airborne systems, and communication systems. No fighter jets or tanks here for L3. But in a world that has become so digitized, especially when it comes to combat, L3Harris all of a sudden becomes a very critical defense component. Since July 2019, when L3Harris became its own company, it has outperformed both Lockheed and Raytheon by a good margin. L3 has seen its revenues explode starting in 2019 and through 2020, which has also lifted its EPS from just $4 a few years back to over $9 today. In terms of cash flows, those have also jumped higher outside of the pandemic year, and all of this has led to help fuel the growing dividend. Speaking of that dividend, L3 Harris currently yields a dividend of 1.9%, and over the past 5 years, they have increased that dividend an average of 15.4% per year. The dividend is plenty safe with a payout ratio of just 33%. As of the company's most recent quarter, they have $420 million of cash on hand and total debt of $7.8 billion. EBITDA generated for the trailing 12 months was $3.5 billion, meaning the company has a debt to EBITDA ratio of 2.2. Analysts are expecting EPS growth of 9% in the year 2023. Using those projections, shares of LHX trade at a forward price to earnings ratio of just 16.3 times. Analysts covering the stock rate the shares a moderate buy, with an average 12-month price target of $287, suggesting 24% upside from current levels. The fifth and final dividend growth stock that we will look at today is Broadcom, stock ticker AVGO. This is our last dividend growth stock, but certainly not our least dividend growth stock. Broadcom currently has a market cap of $221.5 billion. The company is a global semiconductor giant. However, semiconductor stocks, for the most part, have been in the doghouse of late, as they have faced massive supply chain issues that cannot keep up with the demand. However, the demand there, so on one point that is very good, but the companies just cannot fulfill those orders fast enough. However, there are a few catalysts for a company like Broadcom. Let's take, for instance, the CHIPS Act, what has been signed into law more recently that is hoping to bring more of that semiconductor manufacturing more onshore. In the past year, roughly 75% of our semiconductor chips and products and all of that stuff comes overseas. Broadcom has had a hand in many different areas in which their chips are used, from automotive, Internet of Things, wireless, cloud solutions, and many more. Broadcom has simply been printing money. As you can see, their annual revenue figures have grown over the past decade to over $30 billion now. EPS has increased, but the impressive area is how they have managed to focus on free cash flow growth, which is a major reason we have seen the dividend growth that we have seen out of Broadcom. The company is by far the most impressive of the 5 stocks that we're looking at today in terms of recent 5-year dividend growth. Speaking of that, over the past 5 years, the company has increased the dividend an average of 35% per year. Some large increases are mixed in there, which could sway the calc, but nonetheless, the company has been a very strong dividend growth stock. The current yield sits at 3% with a low payout ratio below 50%. Analysts are expecting EPS of $40.13 in 2023, which would equate to a forward price to earnings multiple of 13.6. Compare that to the 5-year average of 15.3 times, and shares of Broadcom do look undervalued at current levels. In terms of rating, analysts rate the stock a strong buy with an average 12-month price target of $699, implying 32% upside from current levels. Broadcom is one of the best semiconductor companies out there. If you're looking for semiconductor exposure, but also a dividend growth stock, look no further than Broadcom. So there we have it, folks. 5 high-quality dividend growth stocks for you to consider for your portfolio. All 5 of these dividend growth stocks are trading at very reasonable prices right now. With that being said, folks, let me know down in the comments section below, what are some of your favorite dividend growth stocks? And if you enjoyed this video, do me a huge favor and click that thumbs up button, as that is huge for the growth of this channel moving forward. Again, I hope you enjoyed the video, and with that being said, we will see you next time. Take care.